right now, and this is an important conversation, Michael Schumacher has essentially seen it all at Wells Fargo and their global head of macro strategy. He's trying to synthesize all. And I love, Michael, what your economic team said in the recent days, that we have to dovetail confidence and sentiment. And I would suggest we have to do that into the markets as well. How do you synthesize our confidence and our sentiment into the autumn?
Yeah, Tom, one data point that's really interesting that relates to confidence is what Taylor mentioned. When you think about the range of forecasts for the upcoming non-farm payrolls, it's huge, 700,000. And just to put that into context, if you look at 2019, the average range in the Bloomberg survey was about 150,000. So once again, people are still sort of groping around. They don't really have strong conviction in terms of where these numbers come out. And I suspect that's going to require another month or maybe two until there's a lot more confidence on the economic side. So translating that to markets, what does it mean? Yields probably stay pretty low. Volatilities sort of perversely stay somewhat high. Equities, I'll leave that to the equity pros, but seem to be doing awfully well. But I suspect it is a month or two until there's a lot more confidence in the markets.
Where is our irrational exuberance right now? I mean, price up, yields minuscule, real yields, et cetera. You know the story. Equity markets so strong Friday. How do you gauge our irrational exuberance?
Yeah, it's funny, Tom, when you think about, let's say, the tried and true Fed model. I suspect it's been a while since anyone's mentioned that on your show. But if you look at that, so thinking about the ratio of earnings to price minus 10-year Treasury yield or the corporate bond index yield, it's actually pretty fair. So a couple hundred basis points, it's in historical norms. So that would tell you that markets are not irrationally exuberant. Perhaps yields are way too low. And that's really the point of quantitative easing. So the Fed is just sitting on the yield curve like a big Goliath. And until Goliath gets off, I think markets are probably in a pretty happy place.
Mike, this is exactly where I wanted to go. Goliath is going to get off, right? I mean, that's what we learned on Friday, is that the tapering probably will begin later this year as people had expected. Yeah, it might be slower than people had previously expected, but it's going to happen. Bond markets shrugged. They not only shrugged, but real yields went even more negative. How do you understand this?
Yeah, the way we think about that at Wells is that Chairman Powell basically said, yeah, we'll get off eventually, but not yet. And that gives markets probably a couple months of runway. If you think about the calendar from a Fed perspective, it's almost certain the Fed will announce tapering at an FOMC meeting. There aren't very many left this year. There's the meeting SEP 22. Is that in play? We doubt it. So then you've got November 3rd. Well, that could happen, but that coincides, unfortunately, with the crunch time for the debt ceiling. So that may get knocked out as well. That leaves us with December 15th. So there aren't too many opportunities left for the Fed. And the market, I think, looked at it and said, all right, so we've got probably a couple more months. This sounds pretty good. Let's rally.
All right.
And it was just about that simple.
I remember back in the day when the Fed would be dovish, you'd see longer term yields rise. And the explanation was that if they stay for longer, it means longer term growth. We're not seeing that anymore. Now we're seeing the yield curve flatten, and I don't understand that. Can you help me?
Yeah, it's been pretty strange, I have to say, Lisa, and having seen a few cycles, it does seem like it's completely counterintuitive, but it strikes me now that what the market really is focused on is one thing, tapering. And any hint that tapering is going to be a little bit more distant, that tends to be bullish for bonds, so yields fall. And if tapering comes a bit nearer, then you see yields back up. And what we got from the chairman at Jackson Hole is tapering will happen, but not anytime soon. So yields sat and actually dropped a little bit. So it's all hinged on tapering at the moment.
Interesting. You talk about the path forward for 10-year yields, Mike, right northward to a 160 to a 190. Is that path smooth?
Probably not. So what we think happens there, Taylor, is you see just a little bit of an uptick in yields over the next month or two. And then we think you'll see much more of a move high, let's say late this year. So perhaps mid-November through the end of the year. I wouldn't be surprised during that time frame if yields rise 20, 30 basis points, perhaps more. So not too much until then, but then quite a bit toward the end.
Sticking on the yield conversation, what is a negative real yield of more than 1% on the 10-year telling you?
Yeah, it tells me the market's giving us very little projected economic return, if you want to think about it that way. So if you're a long-term holder of a treasury and you say, oh, I want to buy a 5 or a 10-year security and hold it to maturity, what do I expect to earn? After inflation, you lose money. So there's really very little motivation for long-term players to be in treasuries. We always think of treasuries as adding ballast to a portfolio. From that standpoint, they're good, or for a professional investor, more of a tactical play. But for a longer term holder, let's say a retail investor, someone might be watching your show or listening, not the right time to get in.